So let's start with some really quick introductions. Um, we will be we are recording this session, and we'll make the recording and a copy of the slides available to everybody who's joined afterwards. So if anybody does miss anything that wants to recap, then of course you'll have all of the different material. So I'm Sarah Jackson, one of the directors at DTP, and this is a session that we ran with a slight difference because Rent Convergence wasn't part of the plan last year. We got some really good feedback, lots of people asking us if we could do it again because they couldn't make it. So we thought we'd do another session really just to kind of focus on rents because it's very topical, but clearly very important in terms of the main income stream for registered providers, and rent reviews, providing advice and guidance around rent setting is something that DTP have been involved in now for well over five probably more years. It's one of our biggest areas of the business now. So today's session, sorry Keith, I'll let you introduce yourself and then I'll go through the contents. Do apologise.
Thanks, Sarah. I'm Keith Edwards, as you probably know. I've worked as a senior consultant with DTP for about 3.5 years now. Perhaps to emphasise what Sarah said in terms of how busy we are on rent standard compliance with clients, albeit I work with the finance and treasury team almost exclusively. I work on rent reviews 5 days a week and nothing else. That kind of probably gives you an idea how busy we are on that, and probably more so now with Rent Convergence around the corner.
Thanks, Keith. So today's session, I'm just going to do a bit of a recap, really, just in terms of the Regulator of Social Housing's approach to regulating the rent standard, and then all of the different requirements for the different categories, both within the rent standard and those accepted categories. Well, then Keith's going to sort of run through some of the lessons learned that have come from audits and regulatory notices, because there's an awful lot of learning there for providers in terms of the things that have gone wrong, the things to look out for. And we're also going to cover just how to provide assurance on compliance to boards, because that is, a fundamental need. It's something that is really important when it comes to inspection, when it comes to just normal regulatory engagement, and obviously, something that organisations will be providing to boards on an annual basis. And then the all topical topic of rent convergence. So obviously announcements made towards the end of January. So we've got some slides there that just really explore what it all means, the emerging implications, the things that providers really need to be thinking about as we move forward. So I've just noticed that somebody in the chat's got a problem with mics. No, sorry, it's me reading it wrong. Ignore me. Sorry, I thought it was somebody that couldn't hear. So we are recording a session and we will be sending a copy out along with the slides afterwards. So if anybody has missed the first part, then you will be able to recap. So one of the things that we put together for you, which hopefully is helpful, are just some key reference documentation. So all the different rent standards, so these have got live links. So the 2020 rent standard, the one that was in place for 23-24, the new one that's been introduced from 26, and then the current government policy statement on rents for social housing, along with the amended one from April, and then the various different Homes England, Homes for London, GLA guidance, so anything around, the affordable homes programme. But also, if anybody's interested, just some of the documents that were kind of the preface to the introduction of Rent Convergence as well. So a bit of a whiz and a recap really in terms of the current approach to regulation. So no surprises, the Regulator of Social Housing is the current regulator. I just wanted to sort of make this point really about the co-regulatory approach and how important that is, particularly in relation to the rent standard. So, the regulator expects the boards and local authority councillors to be responsible for making sure that the standards are met, and if there is any risk or failure to comply, part of that co-regulatory approach is a very open and transparent relationship and communication dialogue with the regulator. So really important to make sure that providers are thinking about that if they do encounter any problems, and obviously self-notifying if they do fail to comply for any reason. So this slide just really picks up on the different regulatory standards. So you can see on the left-hand side the economic ones, and on the right the consumer standards. And the reason that I've put that up is just because we're starting to see now a lot more read across the regulatory standards. So whilst the rent standard has its own, required outcomes, there are also read acrosses through into the different standards, and I've just put a couple of examples up here. So first and foremost, the governance and financial viability standard. So in the orange text there, just some points about being accountable to tenants, safeguarding taxpayers' interests, etc., and really importantly, having effective risk management and internal controls in place. And then, as we look to the consumer standards, equally lots of read across. I've just highlighted here the transparency, influence and accountability standard. So things about taking tenant views into account in terms of decision making. So again, really important when you think about rent convergence and rent flexibility, but equally in terms of rent increases, and effective communication with tenants and actually providing information so that tenants can hold landlords to account. So lots of really important read across there. Also some links through again into the tenancy standard. So I think it's fair to say that the rent standard from our perspective is one of the most complex standards, because it has lots of different rent setting requirements for different types of accommodation. So it would be wonderful, wouldn't it, if there was just one method of rent setting, but there are lots of different ones, and that's what I think makes it quite technical and quite complex. We've also seen significant change over the last 10 years, particularly. There was a new rent standard in 2015, then 2020, 23, 26. So there's lots changing, lots to keep up with, and lots of detail. And I think particularly for boards, how can a board effectively scrutinise, effectively hold officers to account for rent setting if they don't know enough about actually the basics and the fundamental principles? We wouldn't, of course, expect boards to know everything, but I think they do need to have some knowledge to be able to govern effectively. And of course, rents features in the annual sector risk profile. So there's always a section, and I've got the next slide just sort of highlights what the last one said. There doesn't tend to be much change in terms of year on year, just some nuance, some more emphasis, perhaps changing year on year. But there have been a number of addendum to sector risk profile documents published. So 2018-19 in particular. So again, one of the areas to really make sure providers are considering. What other things to pick out? So I think terminology, I don't think anybody likes acronyms. Terminology in social housing is obviously full of different acronyms and quite complex terminology, and it's not necessarily easy to follow within the rent standard as well. So hopefully we'll just be able to provide some simplicity to understanding the different requirements today. And we're going to talk about data controls and the importance of data quality as we go through today's session. So absolutely fundamental to rent setting. So I'm not going to talk to this slide. This is just what I mentioned before in terms of the sector risk profile and the focus on rent setting. So I'm just going to move on now to just unpick very, very quickly some of the key points of rent standard application. So I think the most important starting point really is to understand, when does the rent standard actually apply for a registered provider? So essentially, whenever you have accommodation that is owned, whenever it is leased, or when it is owned but managed by others, so where essentially the registered provider is the landlord, It doesn't apply if the registered provider is the managing agent on behalf of another registered provider. So in that situation, it is the landlord, it is the registered provider who is the landlord who actually has the responsibility to set rents. So I think just an important sort of clarity point really in terms of the starting point. So on this slide, you can see the 3 different types of rent standard categorisation that are regulated. And by that, we mean where there are very specific requirements for how you set rents for these categories. We are going to touch on the accepted categories as well, where there is a lot more flexibility around rent setting, as long as you can meet some of the very stringent requirements that come with these categories. So social rent is by far the most common rent standard category, probably will cover the vast bulk of social housing within the country. And there is a very prescriptive formula for setting social rents, as I'm sure everybody's aware, and that hasn't changed since 1999. So it does feel odd that we are still setting rents in 2026 based on a formula that was developed in the 90s, but that is the case. There's no direction to change that. So essentially, a formula rent is worked out as at April 2000, and then it is uprated every year to get to what's known as the maximum formula rent in 2026. So we quite often hear terminology around target rent. So target rent is outdated now. It was what formula rent used to be known as way back when, but formula rent is the correct terminology to be using moving forward. So there are some complexities in terms of social rent. So the first is that it excludes service charges. So that's a positive. So this is just about the rent element, not the service charge. But you also have what's known as an upper rent cap. So that is a level by which once you've set your formula rent that you can't go above. So you have to do that check to what is known as the rent cap, and the rent caps are set out every year by the regulator, and they're in bedroom size, and they increase by CPI plus 1.5% every year. So that means that as your rents are generally increasing by CPI plus 1, the rent cap is increasing by more than that. So gradually over time, there becomes more of a differential between the rent cap and formula rent. And then rent flexibility. So this is, as it suggests on the tin, some flexibility to increase rents over and above the base formula rent level. And it's there to give providers some flexibility to, have rents that actually reflect their tenant base, their communities, and their particular circumstances. So you're able to increase that base formula rent by up to 5% for general needs accommodation, or up to 10% for supported housing. So what's really important if you are utilising rent flexibility is that you have a very clear board approved rationale for using it, and that's normally contained within the rent policy, which would say we utilise rent flexibility for XYZ reasons. And I think it's pretty much to say now that most providers are making use of rent flexibility, even if they haven't done historically. It's one of those things that we are starting to see some providers really think about now, if they haven't used it, because there's just so much expense coming down the line for registered providers. Maximising income levels as far as possible is really, really important. And rent flexibility, if you haven't previously used it, can only be used from a point going forward for new tenants. So if you haven't made use of it, you can't start to make use of it for existing tenants. It's just something for new tenants moving forward. So other key things just in terms of social rent. So fair rents are a form of social rent. And these are sometimes known as secure tenancies. So these are pre-1989 tenancies where the rent is set very differently. So the Government Valuation Officer Service, the VOS, you have to apply to that service to actually set the rent for a fair rent tenancy. It can include or it can exclude services, and it will be very clear about whether it does or it doesn't. And these are applied for every 2 years. So you would apply and you would keep reapplying to the valuation office service for that rent. But in 2015, there were some other introductions in terms of the link back to a social formula rent. So whenever a fair rent set by the valuation office, once that reaches the equivalent social formula rent, it is capped at social formula rent. So even if that valuation office rent continues to grow, you are limited to charge a social formula rent. You cannot go above that level. But what's more important is that you don't go above the valuation office level either. So you can't track up to formula rent without that valuation office determination being at that level. So it does make it quite complex. And to add to that complexity, annual increases have also been capped at the regulatory level since 2015. So that's the CPI +1 or whatever it was in that year. And that again is something that Keith will pick up later on, because it's not something necessarily that providers are aware of or sometimes adhere to. So the affordable rent, so a bit simpler but very different from what we've previously just described in terms of social rent and formula rent, social rent and fair rent. You at the moment you can only charge an affordable rent when you have some kind of formal delivery agreement with Homes England, the GLA, or the Secretary of State if you're a local authority, and that's going to change from April. So the new rent standard does give far more flexibility to actually charge an affordable rent without that formal delivery agreement. But for now, that, and obviously tenancies, prior to 2026, that is the case. And the other big difference with affordable rent, of course, is that it is inclusive of service charges. So the very principle of affordable rent is that you gather a valuation of the comparable market rent of a property, of a similar property, and then you set your gross rent, which is your net rent and your service charge, at no more than 80% of that gross market value. So affordable rent is set at tenancy commencement, and once you've set that rent, you are then just increasing it every year by the permitted annual increases. But the other key requirement of affordable rent, which doesn't apply for any of the other categories, is that you also need to fully reset that rent at relet. So that means that you have to get a new valuation, and then you have to repeat that exercise of looking at what the market is and making sure that the rent at that tenancy commencement does not exceed 80%. So the policy statement on rents for social housing, lots more in there other than what we've covered. We have just drawn out the main points, but it is really clear about conversion of tenures. And this again is something that we do see happening from time to time, which can quite often not be permitted. So essentially, once you have a social rent property, it remains as social rent, and you can't convert it to any other category. There was an exception to that when the Affordable Homes Programme, an affordable rent was first created in 2011. There was a conversion programme at that time, but that is the only time at which you can change a social rent property. So you can use it for different purposes by all means, but it's the rent that you charge has to always remain as a social formula rent. And thankfully, the new 26 rent standard is just a lot more clearer around that particular element, whereas it's always been in the previous ones, but it just hasn't been as clear. Supported housing definition is also within the policy statement, and this is relevant to social rent, where you are charging the 10% rent flexibility, and where you're claiming some other exceptions that supported housing benefits from. So the exemption of the first year of rent reduction in 2016, and also in 2023, the 7% cap on existing increases didn't apply to supported housing. But what's really important is that you make sure that you can actually meet the definition of supported housing. It's not that difficult, but it definitely means that the accommodation has to come with the supply of support for people who actually need support. It can't be an opt-in and an opt-out situation. It's got to be people who actually need that support. And again, there are some other provisions in there, such as tenants for high incomes, but typically we just don't see providers utilising this. They are there and they continue to be there in the 2026 version as well. So I'm going to come on to the accepted categories in a second. So just before I do that, just again, a couple more points to just sort of raise in terms of supported housing rents. So quite often we get asked what the rent setting requirements are for supported housing rents, and providers think that there are different requirements or different options, but essentially there aren't any different options other than the rent flexibility, of course, that's afforded for social rent. So they have to fit into the same categories. So it has to be, you know, social rent, affordable rent, or typically one of the accepted categories. The other point just to make again, which crops up from time to time, is that if accommodation is treated as exempt accommodation for housing benefit purposes, it doesn't mean that there are any exceptions from the rent standard. So the two things are entirely very different and shouldn't be confused. So, you know, exempt accommodation has got very clear meaning within housing benefit legislation, but it doesn't then translate into the accepted categories from the rent standard in any way. So please don't think if you think you've got exempt accommodation, you don't have to apply the rent standard. You do. You just need to find out which category that exempt accommodation fits into. And the last point really is just to sort of draw out, and again, those of you who've got affordable rent supported housing schemes, you may well be finding now that you're needing to subsidise some of those services because, of course, affordable rent includes service charges, and that means that your annual increases are limited. And we do find that some providers are not able to pass on the full costs of their rent and their service charges because the service charge could be increasing by more than they're permitted to increase that gross rent every year. So it can be a real challenge. Thankfully, the Affordable Homes Programme over the last few years has actually introduced a lot more social rent, and that's set to continue, of course. So it's just a pointer really in terms of just being really careful about utilising affordable rent for supported housing. So I'm going to pause in a second to come back at some of the questions that have been raised in the chat. So accepted categories. So these are the categories where you do have more flexibility to set rents that, you know, aren't prescribed by what we've just touched on in terms of social rent, affordable rent, etc. So each of these categories, they are outlined in full in chapter 5 of the policy statement, and each of them has some very specific terminology. But the most important thing to remember, which again isn't, it is in there, but it's not necessarily, you know, in really bold text, is that Section 69 of the Housing and Regeneration Act applies to all forms of low-cost rental accommodation. And the accepted categories are still forms of low-cost rental accommodation or social housing, essentially. And what the Act says is that in order for accommodation to be classed as low-cost rental accommodation, it A, has to be made available for rent, which is pretty straightforward. B, that the rent is below the market rate, which isn't straightforward. And that the accommodation is made available to people whose needs are not adequately met in the commercial housing market. So the reason that we've highlighted the rent being below the market rate is that if you think about some of these categories, they generally don't even exist in the private market. So when you would be looking to see what the market rate would be, you would normally go to the private market. So what this means is that you still have to have valuation evidence to identify what the market would be if it existed, and then you can evidence that the rents you are then charging are below that level. So it's probably not for today because it's a topic in its own right. But there are some very specialist valuers now who've developed really robust methodologies for actually dealing with this issue. So if any of you do have, any of the accepted categories that you're claiming, I would just urge you to really think about, have you got the evidence to make sure that your rents, were set at below the market rate to start with, but are continually below the market rate even when you're applying those rent increases. And I'm just going to look at specialised supported housing, which is one of the accepted categories. The main reason being this is probably the most complex of all of them. So you can see there that there are some very specific requirements. Firstly, meeting the requirements of supported housing as defined in Chapter 2 of the policy statement. And then you've got A to E, which all are very different and some of which are very complex. So A is pretty straightforward because you could essentially designate for occupation a property. You don't need to have, made alterations or purposefully designed it, for this purpose. You could just designate it for occupation by individuals who need this kind of support. But it's B, C and D that are really quite complex, because this means that you need to have tenants who have a requirement for a high level of support, which approximates essentially to the needs that would be provided in a care home for people who the only acceptable alternative would be a care home. So if you think about the different levels of need that you have within social housing, you might have, for instance, sheltered housing, which has got, can have very low level need levels, moving through into kind of more complex forms of supported housing or even extra care housing. But again, need levels can vary. Some people have more support needs, others have less. So specialist supported housing is above all of those in terms of that continuum, and sits below a care home. So people typically who would need 24-hour care, for whom just couldn't live in normal supported housing, for want of a better word phrase. So this is about people who've got very complex need levels. So you have to identify need levels on a tenant basis as well, which can make it even more complex. And then C and D really refer to this type of provision being a service that is commissioned by a local authority or a national health service provider. And that's because there has to be an agreement or an arrangement with those providers, and they've also got to approve the rent that is charged. So that all kind of aligns to some form of commission service. Doesn't need to be a formal contract. It could just be an informal acceptance agreement, but there is that requirement there to have that link back to the local authority or the NHS provider. And then the final point is about having either no or negligible public assistance. So that's grant. So again, if you have developed this kind of accommodation with any kind of grant, you can't claim this exception. Or if you have had public assistance, that it is connected through the property by means of a charge. So this sometimes happens, or has happened historically, with the NHS, who have perhaps gifted a property to be used for a specific purpose. But if it then ceases to be used for that, it then goes back into the ownership of the NHS. So there are some very specific requirements there around specialist supported housing. And if anybody's wondering about how to evidence any of that, then we can provide support and advice separately, because it is very complex. So before I hand over to Keith, I'm just going to put up the chat and just see if anything is popping up. So one question, I've read the new rent standard as not allowing conversions from social to affordable. Is that not the case? So no, it is the case. So once you've got a social rent, you can't charge it to any other form. What you can do is actually, if you're developing new accommodation, you can charge an affordable rent for it now without having a supply delivery agreement. So you don't have to have that delivery agreement with Homes England, but you can't convert an existing social rent property, if that makes sense. Do you know whether almshouses are accepted? So if an almshouse is a registered provider, the rent standard applies. Not all almshouses are registered providers. So if you're not a registered provider, you don't have to apply the rent standard. I'm just going to flip to the Q&A because I think there is some more in there. It's not loading. Keith, do you want to carry on and I'll just keep an eye? Oh, sorry, no, it's come back. It's come up now. Sorry. Specialised supported housing. Should this still be low cost rent? So this is the point. So specialised supported housing, typically rents are far higher than you will find in social rent, affordable rent, etc. So I'm going to use £400 a week as an example here because we quite often see rents that are significantly high for this type of property. What's important is that you have to determine what the market would be. So, as I mentioned earlier, the market often doesn't exist, but if it did for this kind of accommodation, what rent levels would the private market be charging? So if you were thinking of charging a rent of £400 a week, you would need to evidence that the market was £400 or above. So, sorry, £401 or above, because even if you set it at 400, it's not below the market rent. And the other challenge is that sometimes the market changes by differing levels than which you might want to actually apply your rent increase. So it's important to make sure as well that when you apply your annual increases, you're taking account of the rent levels and how far apart from the market they are, to make sure that by applying a rent increase, you don't inadvertently tip that rent above the market rent level. So, and again, I think there's another question which is slightly linked to that in terms of how can they be determined. So it's really complex and probably a discussion for another day. So if either of the individuals who've put questions up about specialised supported housing or valuations want to pick up a conversation, we're more than happy to do that. It really isn't straightforward and it's a really good question to ask. Right, over to you, Keith. Thank you.
Thanks, Sarah, and afternoon again, everybody. Yeah, just to touch on a couple of points Sarah had raised. I think it's probably fair to say everybody listening will be aware of this anyway, but setting rents really is, I wouldn't say it's overly complex, but you've got so many variations to look at, whether you've got properties falling within the rent standard or in accepted categories. And obviously, if you're lucky enough to have quite a varied stock across all of those, it's very, very complex to be setting rents on those and keeping on top of all the the regulatory changes. As you probably know, DTP obviously support a lot of clients, as I mentioned at the top of the call. Literally 5 days a week I'm doing rent reviews and nothing else. It's a popular topic. In all honesty, we could probably spend the best part of 2 hours going through all the themes that tend to crop up on rent reviews. To put your mind at rest, we won't do that because we're very conscious of time today. But the risks, inherent risks, as you probably gathered, of incorrect rent setting, we've got some summary points here. If you read through them all, there's a theme that cuts across every single part, which I've got on the bottom of the slide there, which is cost. And often that's a cost across all of those 4 areas: reputational, regulatory, financial, and time. I think time cost, and again, most of you are going to know about this anyway. There's not enough hours in the day to be doing the day job as it is. But if you've been through a rent review, if you've had a visit from the regulator, the cost of actually putting that right in time is significant. You're obviously looking at rebasing rents, calculating overcharges, validating the work that's been done to ensure those figures are correct, putting a system in place to process refunds to customers, and even the challenge of contacting existing customers and former customers. So it's far from straightforward. But again, cost cut through all of that in terms of the risks. Can we have the next slide, please, Sarah?
You can.
So regulatory cost, no great surprise, could obviously be quite significant, particularly when there's a judgment or a downgrading that might come as a result of that. And the themes here, really the outcome of poor rent compliance, they're all from judgments. Some of them you're probably familiar with that have been published over the last couple of years. And these tend to tie in fairly typically with the sort of results we see from our own rent reviews. And a lot of those, it's probably fair to say, aren't particularly isolated to one area of non-compliance. A lot of them are across at least three or four of those points you can see on the slide. While there's a lot of different reasons behind why rent setting goes wrong and why you end up with a judgment, the process a lot of the time, which triggers those compliance breaches, is really down to systems and controls, or I probably should say more accurately, issues or problems with those. Next slide, please, Sarah. So I mentioned our own review work, and obviously the outcomes of what clients have learned from that would probably fill a couple of hours, but obviously we won't go into too much depth. But I thought it might be helpful just to touch on a few issues and a few things that crop up on a fairly regular basis on probably 99% of the reviews that we do. Sarah mentioned before that probably social rent, whether it's general needs or supported, is probably the biggest element of most people's stock, I would say. And breaches on formula rent, really a lot of the time, we've got quite a complex formula to drive what the formula rent should be. You only need one piece of that data to be incorrect, and it's almost like a house of cards, isn't it? The whole thing falls over. And the common issues tend to be, when we're looking at breaches of formula rent, really two or three things: an incorrect 99 value, or perhaps a rent's been calculated on a general needs basis when it should have been supported, or something that's becoming more common now. If you've got shared accommodation, so for example, you've got a detached house that's split into, say, 4 units, is how that bedroom count is actually recorded accurately, which drives the formula rent. So as you're probably aware, if it's a bed sit or a room only, technically that needs to be classed as a 0 bed. But a lot of the time when we're doing reviews, a 1 bed categorization comes up, which straight away is going to put that tenancy in an overcharge position. Affordable rents, Sarah touched on before, and as you probably know, when the property's relet, particularly if you've had a long-term tenant there, you need to get an up-to-date market value rent. So obviously you're letting the property at the correct rent, and you probably know the golden rule that's got to be set at no more than 80% of the market rent. But again, fairly common on a lot of the reviews we look at. We come across situations where tenant A has moved out, tenant B has moved in, and the rent from the exiting tenant has just had, if it's crossed into a new financial year, just had a CPI plus 1% increase stuck on top of that. Drilling down on that, obviously that's not the correct way to do it. So a lot of the time providers are having to obtain retrospective valuations, and when you work the maths through, a lot of the time those tenancies are now in an undercharge position. So really there's a huge loss of income. Just sticking with affordable rents, just to finish off on some themes. Equally, we see situations where the rent only part of the gross rent has had a CPI plus 1% increase applied to it, and then the service charge has been added on top. So then when you look at the overall increase, a lot of the time that's actually breached the limit of CPI plus 1% as well. So there's a lot going on there, in terms of regular themes that pop up on virtually all the reviews. Last thing I wanted to mention on this, Sarah mentioned specialised supported housing before, something which was only if I can use the phrase, once in a blue moon on reviews, but tends to be on literally every single one we look at now, is when we drill down in terms of whether that's had any funding or grant. A lot of the time we're finding schemes where that they have had grant funding, but as Sarah said before, the rent has then been set at a lot higher than it should have been. Really, the base there that you can't go over is social rent. If you've had grant funding, that has to be charged as social rent. So as you might imagine, there's fairly significant overcharging as a result of that. Get the next slide, please, Sarah. So we thought it might be useful to look at perhaps some of the reasons behind the breaches. And obviously, from a review perspective, we drill down a little bit more than just looking at the numbers with the clients. And really what we're trying to establish is what practical steps we can put in place to improve those processes and really stop a repeat of any of those compliance errors in the future. Just a few main reasons why errors tend to occur. They're typically, as Sarah mentioned before, they tend to be poor data quality, or that could be gaps in your internal processes, poor or sometimes completely missing data, that there's just no data at all on a system to be able to realistically do a rent review on a tenancy account. And a lot of the time, the theme that's thread through all of that is insufficient quality assurance checks. Something else that's happening on a fairly regular basis now, it's quite rare a couple of years ago, but it seems to be the case on a lot of the recent reviews we've done, is errors in rent models. So you could argue, well, what is a rent model? Are we talking about brick stuff? In the context of what I'm talking about, we're really talking about whatever you use, which for most of us is probably going to be an Excel spreadsheet, isn't it? What do you use to actually calculate a formula rent? And as we know, you only need one part of that rent model to be wrong. And again, the house of cards analogy I mentioned before, it all falls to bits. And really from day one, and particularly if that's across multiple tenancies that you're using the same rent model for, the cost of that can be significant in terms of the overcharge. So really, again, the driver for this is data quality, and the systems that manage that are obviously integral to getting things right. And it's not to say that suddenly we need to raise our awareness of this because we've got rent convergence about to pop up. But again, all of this stuff is important anyway. But as you might have gathered, which we're going to cover in the next few slides, rent convergence adds yet another layer of complexity to that. So next slide, please, Sarah.
I'm just going to say, Keith, just before we go on to rent convergence, there's just a couple of points just to pick up really from the Q&A, if that's okay. So quite a few questions about shared ownership, and I didn't cover shared ownership because again we could be here all day, but so shared ownership is one of the accepted categories, but the rents for shared ownership properties are set by the lease. And so for providers who've got, you know, a mixed variety of different shared ownership properties developed at different times, you will have different leases, and each lease will have differing requirements around the rent setting and rent increase clauses. The only way that you are free to set rents in accord and, you know, to create your own mechanisms within the lease is if you are developing shared ownership without any grant. But most forms of shared ownership come with grant, and it's the grant agreement that is very specific about how you set the rent and then how it is increased. And over time, there have been lots of different model leases. Some have used RPI figures for the increases, some have used CPI. Some of the really old leases, the rent increase mechanisms are just incredibly hard to even read, never mind understand. So again, really important to actually understand for each property what is the specific requirement for that property, because you can't just treat them all as the same. And then we've had a variety of questions about 1999 value. So again, probably don't have time to go into this much today, but happy to pick up a conversation because we are finding providers now who are doing a lot more data checks on their 1999 values, which is really good, but they are then finding errors. So, you know, a common error is a particular value that is attributed to a 2-bedroom property as well as a 1-bedroomed in the same street or same block. That normally wouldn't be the case because you would have a differing residential value for a 1-bed versus 2-bed. So, you know, there are mechanisms in which you can then, you know, get properties, you know, get new valuations to understand what the valuation should be, But what's really important is that you've got a sound basis from which to do that. You can't just periodically revalue all of your properties to get different 1999 values, because as sure as eggs is eggs, if you're valuing a property in 2026 versus valuing it in 1999, the data that you'll be using is different as a valuer, and therefore you will arrive at probably different values. So happy to chat to people separately if that would help. Thanks, Keith. I shall move you on.
Thank you. Yeah, so really positive news. Without me sound like the prophet of doom, we don't tend to get good news, do we, in terms of housing? We're all very, very busy with a lot of things. But for those of you who are probably long in the tooth like me, you probably remember that convergence isn't necessarily a new thing. It's a welcome back from something that was actually introduced in 2002, ran up until the end of 2015. So the fact that it's back, I've yet to meet a client who thinks this is a bad thing. But obviously, in terms of capacity, that's going to unlock a lot of funds, depending on your size and how you are in terms of the extent of your social rent undercharging position. We'll come on to some examples of that in a minute, but you're looking at obviously extra funds to be building more affordable homes, help to fund on ongoing building safety remediation works. Fire safety measures are obviously a hot topic at the minute, if you pardon the pun, and also to prepare for the new decent home standards. So as I said, it's really going to depend on what your undercharge position is overall as to how significant that's going to be for you as an individual provider. Have the next slide, please, Sarah. And again, the basics of this you're probably familiar with now. Format is relatively simple. So in terms of convergence, if your tenancy or tenancies plural are under the formula rent limit, we can add a £1 a week from April 27. That's on top of the normal CPI plus 1% increase, and again rising to £2 a week. That can also be applied to fair rent tenancies. I'll come back to that in just a second. So the golden rule is the rent charge at the point where you're looking at the viability of convergence. It needs to be under formula rent, but the big difference is that we're only talking about up to the formula rent level. If you're charging a 5% rent flex on top of your general needs tenancies or 10% unsupported, again, convergence isn't going to let you go up to that higher limit. It's the formula rent only. And obviously what we're trying to do in terms of this working through it properly is at some future point, on the average from what we've seen at the minute, tends to be maybe 4 or 5 years from a lot of the undercharged tenancies we looked at, is for that rent charge to equal formula rent. And at that point, it's job done and convergence has done its job. Just a quick point to pick up on fair rent tenancies. Sarah mentioned before, you're probably aware that we've got a situation where you're either going to charge a social rent or you're going to charge the registered rents. The simple rule with that, it's the lower of the two. So in the situation where social rent is lower than the registered rent, there's where your focus is going to be to say, right, well, the rent we're charging at the minute, is that below formula? If it is, then again, you can apply rent convergence until you get to the point where you've got parity between formula rent and the rent charge. Next slide, please, Sarah. I'm conscious of time. I'll try and whiz through this fairly quickly, but there's a lot of other things besides the math side in terms of rent convergence. I think the math side is relatively straightforward, but obviously with the introduction, there's a whole host of other things that we need to be considered, and not to suggest that you don't have robust processes in place for rent setting at the minute, but there's extra layers of complexity you now need to consider. So one of those we talked before about models, they now need to be tracking the normal CPI plus 1% increase plus that additional convergence amount, but against formula rent only. So Sarah mentioned data quality and data integrity before. Absolutely vital that is accurate to the penny for convergence to work properly. But I think it's probably fair to say that there's also needs to be a process in place for capping that rent at the point where the rent charge is in line with formula rent. And then obviously, if I can use the phrase, you turn in the convergence tap off at that point. The obvious risk, I suppose, to flag at this stage Once you get into the second, third, fourth year, and you've got that limit of an additional £2 a week, if the maths suggest that in the final week to reach convergence, you only need a top up of, say, 75 pence a week. If your system isn't robust enough to spot that and do something about it, then you could actually be in a situation where you flip the other way and you've gone from an undercharge to an overcharge, and straight away you've got a breach in your hands. Practical terms, it's really looking at how individual rent counts are going to be managed. So, for example, if you look at your housing management system, does that really have the capability to automate some or all of that when you're talking about convergence? Or is it perhaps going to be the case, well, that can only handle percentage increases rather than erroneous amounts of £1, £2 or 75p? So again, probably from our own experience, a lot of clients tend to use Excel for that. So it may well be the case if your housing management system isn't going to stretch to cover rent convergence, you may have a situation where you're actually completing manual calculations and uploading that into the housing management system. So obviously from a governance point of view, from a systems and controls point of view, there has to be other layers added to that to say, well, how is that going to work? What checks are going to be in place? Sarah's going to talk about board assurance in a little bit, but obviously there needs to be another layer to prove to your board, well, this is how it works, and here's the proof in terms of evidence in that. Last but not least is tenant engagement. Again, I suppose the question on that is whether you would go out to consultation on that, or is it simply a case that you would communicate that increase in the same way you would do the normal annual increase. So obviously what other consideration needs to be given to tenant affordability. If you start getting queries on this additional £1 or £2 extra, how is that going to be explained? So again, besides the systems element we're talking about, besides the maths element in terms of working out convergence, there's also managing tenants' expectations in terms of what they can expect. And I suppose, to be frank, if they're going to say, right, well, what are you doing with that extra money, to be able to have a process in place to explain that. Next slide, please, Sarah, which I think is our example. We've got a couple of examples to show you. This one is a little bit contrived, which you've probably spotted at the bottom there. When we get to year six, we've got rent convergence with rent and formula rent matching equally, and surprise, that equates to £2 a week at the back end there. But in practice, that's probably not going to happen. But just to kind of walk you through, as you can see on the first row, our rent charge is roughly about £10 under the formula rent, which, depending on your own experience, maybe looks quite sizable. But again, from the reviews we've looked at, we've seen lots of different examples of that. So, for example, that could be a longer term tenancy, perhaps where convergence hasn't been applied first time round. Could perhaps be a legacy stock transfer that's already been in an undercharged position for some time, or possibly even a general needs tenancy, which was subject to the the 7% rent cap in 2023. So it's been under for for the last few years. But basically, what we're trying to achieve is obviously parity between that rent and the formula rent. So at week 6, we can actually do that. But I think what would be an interesting point probably throughout, rather than just boring you with graphs and tables, if you strip out the sort of regular CPI plus 1% increase you're getting on this particular example, and just said, well, look, what's the impact of those £1 and £2 top ups plus the inflation increase on that? It comes to roughly about £1,900 over that 6-year period, i.e., that's the difference between applying convergence and not over that period of time. So simple maths, I know, but if you had 100 tenancies in the same sort of position, that's £190,000 extra income just over that 6-year period, which obviously is going to pay for a lot of repairs and improvements. Sarah, I think we'll skip over the next slide, which is the chart, because essentially that's just a chart version
of be able to see that one.
Yeah. What we had before. Yeah. So the next one we're going to look at is probably one that's more relevant to everybody, because most of the clients we speak to tend to include rent flexibility. So this is where we've got a 5% rent flex, obviously on a general needs tenancy. So again, just to recap, undercharge position on that, similar to the first example, we're about just over 10 quid under formula rent plus flex. However, the golden rule, as we know, is we need to monitor year on year what's happening with the rent versus the base formula rent. Really, the formula rent plus flex doesn't come into it. So slightly different version here. We've achieved parity or convergence in 4 years by the end of 2030, 31. And this is probably a more realistic example rather than us ending on £2 a week. We only need 71p increase in that final year. Similar sort of thing if you work it through in terms of just the impact of those convergence top-ups, that is roughly equivalent to about another £784 income in that 4-year period. So again, that's 79,000 over our fictional 100 tenancies. Again, Sarah, I think we'll skip over the last slide, which again is the chart. So just briefly to knit that together, as I mentioned before, there's a lot of things you need to think about besides, as I keep mentioning, the math side of things. There's a lot of systems considerations to look at, staff training to look at as well. Although you've got colleagues that work in income and rents teams, this is the new kid on the block, isn't it? So from a compliance point of view, is everybody skilled up sufficiently well to manage these new processes and know exactly what to do? Shameless plug, as we've got on the slide, we're more than happy to help you with that, because obviously you support a lot of clients doing that now, and we're already getting a lot of requests to help with rent convergence calculations. I think that's my bit done, Sarah, so back to you.
Yes, thank you. So this is just to really kind of focus in on board assurance and the types of board assurance that you should be thinking about, really. And essentially, we talked about previously having a rent policy. So, this is a really important document. There isn't any specific requirement to have one, but I'm not sure how you'd manage to set rents without having a really clear policy in place. So, the starting point is a policy which firstly identifies all the different tenures, categories that you've got, and how you will set rents according to each of those different requirements. But it will also cover, any of the exceptions that you are claiming and how you ensure that you are meeting the evidence requirements, as well as, the things around if you're going to utilise rent flexibility, rent convergence, etc. So something that absolutely should be updated, we think, at least every year. There's just so much change. They quickly become outdated if they aren't kept up to date. But it's not enough in itself. So just having a rent policy isn't enough. Data quality, we've touched on throughout the session, really, in terms of its importance. So thinking through, how do you know that the data you are using is correct? Really important point. So again, a crucial part of assurance in terms of rent setting. And then, internal controls, making sure that they are in place, that they are robust. But how do you know that they are robust? What evidence do you have to make sure that is the case? So you might have to think about, internal audit reviews or external audit reviews, just to make sure that you are considering all of the different mechanisms that you've got in place to, to set rents, and then to make sure that they're correct. So we touched on there about, officer-led certification is fine. So doing some of those internal checks and balances, but that's not enough on its own. So, it should always be supported by external opinion, independent opinion in terms of, the rent setting, the approach to implementing your own policy. And sometimes we find that some forms of internal audit report are actually only looking at, are you following your policy? Not actually, are you setting rents correctly in the first place? Is the data correct? Are your formula rents correct? That kind of thing. So really important to think through all those different types of assurance. And as I mentioned right at the beginning, making sure that your board know enough to effectively scrutinise rent setting. You wouldn't expect them to know everything, but, certainly as a board, if they don't even realise there are different types of rules in place, how can they effectively scrutinise rent setting as a board member? So training is probably something to think about. So we've come to the end of our session now, and I'm conscious there's lots of questions in the chat we've not yet been able to cover verbally or be able to respond to, but we will make sure we do that after the session. And our contact details are in the slide deck, so please do reach out if you'd like to pick up a conversation and talk about anything, you know, around rents or rent convergence, because we can see that obviously there is an awful lot out there that people are really keen to learn more about. So thank you so much for attending. I hope you found it helpful. It'd be really good to get some feedback if possible, and do look out, follow us on LinkedIn. We do sessions quite regularly. We also have a mailing list that you can sign up to, and you can find that on our website, and we do briefings about all kinds of different things. So look forward to the next session, and thank you for your time.